Don't buy XRP until you see this. The ETF game changer. Yo ETF enthusiasts, welcome back to the channel. Today, we're diving deep into the world of the highly anticipated, and still non-existent, XRP ETF. Buckle up, because we're breaking down everything you need to know. Is it a friend or foe for your portfolio? We'll unveil the pros and cons, comparing it to direct XRP purchases. Should you wait for the ETF to launch? We'll settle the debate and give you the expert analysis. Are Wall Street sharks scared of XRP ETFs? We'll spill the tea on their potential impact and how to potentially profit. But before we dive in, smash that like button and tell us in the comments, are you Team XRP ETF or Team Direct Purchase? The battle lines are drawn. Question 1. How does the ETF's exposure to XRP differ from directly buying XRP on the open market? As of February 21, 2024, there are no approved ETFs directly holding XRP in the United States. However, some European ETFs offer exposure to XRP, and understanding the differences between those and direct XRP purchases is still valuable. Here's a breakdown. Buying XRP directly. 1. Direct ownership. You own the XRP tokens themselves, stored in a crypto wallet. 2. Full control. You have complete control over your XRP, including buying, selling, transferring, and staking. 3. Higher volatility. XRP's price fluctuates directly on the open market, potentially leading to higher gains or losses. 4. Security risks. You're responsible for securing your wallet and protecting your XRP from theft or loss. 5. Technical complexity. Setting up a wallet and managing your XRP requires some technical understanding. Investing in an XRP ETF. 1. Indirect ownership. You don't own the XRP directly, but rather shares in the ETF that holds XRP. 2. Limited control. You can buy and sell ETF shares on an exchange, but not directly manage the underlying XRP. 3. Lower volatility. ETFs tend to be less volatile than individual cryptocurrencies, offering smoother price movements. 4. Professional management. The ETF provider handles the storage and management of the underlying XRP. 5. Potentially higher fees. ETFs typically charge management fees, which can eat into your returns. Key differences are: 1. Ownership. Direct purchase gives you direct ownership, while ETFs offer indirect exposure. 2. Control. Direct purchase offers full control, while ETFs limit your control to buying or selling shares. 3. Volatility. Direct purchase exposes you to full volatility, while ETFs offer potentially lower volatility. 4. Security. Direct purchase requires personal security measures, while ETFs rely on the provider's security. 5. Complexity. Direct purchase requires technical knowledge, while ETFs are generally easier to use. 6. Fees. Direct purchase usually has lower fees, while ETFs charge management fees. Additional points are: 1. XRP ETFs are still relatively new and may have limited liquidity compared to direct purchases. 2. regulations surrounding XRP and crypto ETFs are constantly evolving, so it's crucial to stay updated. 3. Carefully research any XRP ETF before investing, considering its fees, tracking record, and investment objectives. Question 2. How do you manage the liquidity of the ETF, especially considering potential volatility in the XRP market? There are no approved XRP ETFs in the US as of February 21, 2024. However, understanding how potential XRP ETFs might manage liquidity is still valuable. Here's a breakdown of some strategies. Managing liquidity in XRP ETFs. 1. Creation and redemption units. ETFs typically offer large creation and redemption units, allowing authorized participants, APs, to efficiently convert large amounts of ETF shares into the underlying assets, XRP, and vice versa. This helps maintain a balance between supply and demand for the ETF shares. 2. Market making. The ETF issuer may appoint market makers to actively buy and sell ETF shares on the exchange, ensuring smoother trading and improving liquidity. 3. In-kind creation, a redemption. Some ETFs allow in-kind creation, a redemption, where APs can directly contribute or receive XRP instead of cash, further enhancing liquidity. 4. Basket trading. The ETF could hold a basket of assets besides XRP, including other cryptocurrencies or fiat currencies, to diversify exposure and potentially reduce volatility. 5. Secondary market liquidity providers. Some exchanges offer liquidity programs where market makers provide additional quotes for the ETF, improving its tradability. Challenges and considerations. 1. XRP market volatility. High volatility in the XRP market can still impact the ETF's liquidity, especially during periods of high buying or selling pressure. 2. Regulatory uncertainty. Regulatory uncertainty surrounding XRP and crypto ETFs can create challenges for market makers and APs, potentially impacting liquidity. 3. Counterparty risk. The ETF relies on third-party actors like APs and market makers, introducing counterparty risk if they fail to fulfill their obligations. It's important to note here. 1. The specific liquidity management strategies will vary depending on the individual ETF and its structure. 2. Even with these strategies, there's no guarantee of perfect liquidity, especially during periods of high volatility or market stress. 3. Investors should carefully research the specific ETF's liquidity profile before investing. Question 3. How does the issuer mitigate potential risks associated with investing in XRP? Here's a breakdown of possible strategies. Mitigating risks in XRP ETFs. Investment strategy. The ETF issuer could employ various investment strategies to reduce risk, such as 1. Diversification. Holding a basket of assets alongside XRP, including other cryptocurrencies or fiat currencies, to spread risk and reduce volatility. 2. Hedging. Using financial instruments like derivatives to offset potential losses from XRP price fluctuations. 3. Active management. The ETF manager could actively trade the underlying assets based on market conditions, aiming to capitalize on opportunities and mitigate risks. Custody and security. the issuer would likely choose a reputable custodian with robust security measures to store the underlying XRP safely. This could include 1. Multi-signature wallets, requiring multiple approvals for any XRP transactions, reducing the risk of unauthorized access. 2. Cold storage, storing a significant portion of XRP offline in secure hardware wallets, further reducing vulnerability to cyberattacks. Disclosure and transparency. The ETF issuer should provide comprehensive disclosures about the risks associated with XRP and the ETF itself, including 1. Volatility, highlighting the potential for significant price swings in XRP. 2. Regulatory uncertainty, discussing the evolving regulatory landscape surrounding XRP and crypto ETFs. 3. Counterparty risk, explaining the reliance on third-party actors like custodians and market makers, and the associated risks. Challenges and considerations. 1. Effectiveness of mitigation. While these strategies can help mitigate risks, they cannot eliminate them entirely. The effectiveness depends on market conditions and the specific implementation. 2. Cost implications. Implementing some mitigation strategies, like active management or hedging, can incur additional costs, potentially impacting the ETF's returns. 3. Investor understanding. Investors need to carefully understand the risks involved before investing in an XRP ETF, even with mitigation strategies in place. Question 4. How do the ETF issuer differentiate the value proposition of the XRP ETF from other similar offerings in the market? Here are some potential strategies. Differentiation strategies for a potential XRP ETF. Unique investment strategy. The ETF could focus on a specific niche within the XRP ecosystem, such as offering exposure to 1. Staking rewards. Focus on earning rewards from staking XRP, potentially appealing to income-oriented investors. 2. Smart contract functionalities. Emphasize the potential of XRP in decentralized finance applications, attracting tech-savvy investors. 3. ESG considerations. Highlight the environmental and social aspects of Ripple's sustainability initiatives, targeting ESG-conscious investors. Lower fees. The ETF could offer competitive fees compared to other crypto-related ETFs or direct XRP purchases, appealing to cost-conscious investors. Active management. The ETF could be actively managed by a team with expertise in the crypto market, potentially offering superior returns compared to passively managed options. Educational resources. The issuer could provide educational resources and tools to help investors understand XRP and the ETF, attracting newcomers to the crypto space. Partnerships. The issuer could partner with established financial institutions or crypto platforms to boost the ETF's reach and credibility. Challenges and considerations. 1. Competition. The crypto market is highly competitive, and the XRP ETF would need to stand out from existing offerings like other crypto ETFs, direct XRP purchases, and even other potential XRP-focused products. 2. Regulatory uncertainty. The regulatory landscape surrounding XRP and crypto ETFs is still evolving, which can create challenges in marketing and attracting investors. 3. Investor education. Many investors are still unfamiliar with XRP and the associated risks, requiring significant educational efforts from the issuer. Question 5. How does the ETF structure address counterparty risk? While there are currently no approved XRP ETFs in the US, it's valuable to explore how potential XRP ETFs might address counterparty risk, assuming they come to exist. Here's a breakdown of some strategies here. Addressing counterparty risk in potential XRP ETFs. 1. Diversification. Basket of assets. Holding a basket of assets alongside XRP, including other cryptocurrencies or fiat currencies, can spread risk and reduce dependence on any single counterparty. Multiple counterparties. Utilizing multiple counterparties for different services, e.g., custody, trading, can mitigate reliance on a single entity. 2. Secure custody. Reputable custodian. Choosing a well-established and highly regulated custodian with robust security measures for storing the underlying XRP. Multi-signature wallets. Requiring multiple approvals for any XRP transactions, reducing the risk of unauthorized access by a single entity. Cold storage. Storing a significant portion of XRP offline in secure hardware wallets, further reducing vulnerability to cyber attacks. 3. Transparency and disclosure. Clear disclosure. The ETF issuer should provide transparent disclosures about the counterparties involved and the associated risks. Regular updates. Providing regular updates on the performance and security of the underlying assets and custodians. 4. Legal and contractual safeguards. Legal agreements. Having strong legal agreements with counterparties outlining their obligations and responsibilities in case of default. Collateralization. Requiring collateral from counterparties to mitigate potential losses in case of default. 5. Active management. Active monitoring. The ETF manager actively monitoring the performance and risk profile of counterparties, adjusting relationships as needed. Contingency plans. Having contingency plans in place to deal with potential defaults or other disruptions involving counterparties. Challenges and considerations. 1. No complete elimination. While these strategies can mitigate counterparty risk, they cannot eliminate it entirely. The effectiveness depends on the specific counterparties, market conditions, and implementation. 2. Additional costs. Some strategies like diversification or active management can incur additional costs, potentially impacting the ETF's returns. 3. Investor understanding. Investors need to carefully understand the remaining counterparty risks associated with any investment, including potential XRP ETFs. Question 6. How to define and measure the performance of the ETF? Are there specific tracking benchmarks or performance targets? The performance of an XRP ETF can be viewed through various lenses. 1. Total return. This combines price appreciation and reinvested dividends, the staking rewards, if applicable. 2. Alpha. This measures the excess return of the ETF compared to a benchmark, highlighting its active management skill, if applicable. 3. Risk-adjusted returns. This takes into account the volatility of the ETF to assess its performance relative to its risk profile. Measuring performance here. Several metrics can be used to track and measure performance. 1. Net asset value, NAV, the per share value of the ETF's underlying assets. 2. Market price, the price at which the ETF trades on the exchange. 3. Tracking error, the difference between the ETF's return and its benchmark's return. 4. Sharpe ratio, a measure of risk-adjusted return, considering both return and volatility. 5. Volatility, the standard deviation of the ETF's returns, indicating its price fluctuations. Benchmarks and targets. The appropriate benchmark for an XRP ETF depends on its investment strategy. 1. Passively managed. Track an index like the XRP price index, aiming to mirror its performance with minimal fees. 2. Actively managed. Compare against a broader benchmark like a diversified crypto index or a general market index, aiming to outperform these benchmarks. 3. Unique strategy. Develop a custom benchmark based on the ETF's specific holdings or investment objectives. Performance targets can be set based on various factors. 1. Market expectations. Align with the expected return of the underlying asset or benchmark. 2. Competitor analysis. Benchmark against similar ETFs or investment options. 3. Risk tolerance. Balance potential returns with acceptable levels of volatility. Challenges and considerations. 1. New asset class. Measuring performance in the nascent XRP market presents challenges due to limited data and evolving dynamics. 2. Volatility. High volatility in XRP can make performance measurement complex and susceptible to short-term fluctuations. 3. Benchmark selection. Choosing the right benchmark is crucial for accurate performance evaluation, especially for actively managed ETFs. Question 7. How to compare the performance of the ETF to other alternative investments, such as other crypto asset ETFs or traditional assets. While there are currently no approved XRP ETFs in the US, let's explore how potential XRP ETFs might be compared to other alternatives. 1. Define comparison universe. Crypto asset ETFs. Compare with other ETFs holding cryptocurrencies like Bitcoin, Ethereum, or diversified crypto baskets. Traditional assets. Compare with stocks, bonds, commodities, e.g., gold, or broad market indices for diversification. 2. Choose relevant metrics. Total return. Compares overall price appreciation and reinvested gains, dividends, the staking rewards, if applicable. Risk-adjusted returns. Considers volatility to assess performance relative to risk, e.g., Sharpe ratio. Volatility. Measures price fluctuations, indicating stability or potential risks. Maximum drawdown. Shows the largest peak-to-trough decline, highlighting potential downside risk. 3. Consider time horizon. Short term, focus on recent performance and volatility. Long term, evaluate historical returns and risk-adjusted metrics over extended periods. 4. Additional factors. Investment objectives. Align comparisons with your goals, e.g., high growth, income generation, diversification. Risk tolerance. Consider your comfort level with volatility and potential losses. Fees. Compare expense ratios of the XRP ETF and other alternatives. Liquidity. Assess ease of buying and selling each option. 5. Tools and resources. Financial websites and comparison tools can provide historical data and metrics for various assets. Consult a financial advisor for personalized guidance based on your individual circumstances. Challenges and considerations. 1. Limited data. XRP is a relatively new asset, potentially limiting historical performance data. 2. Evolving market. Crypto markets can be volatile and unpredictable, making comparisons challenging. 3. Apples to oranges. Different asset classes have inherent differences, requiring careful interpretation of comparisons. Question 8. How do the XRP ETF target towards professional investors, and what characteristics define this target audience? It's important to reiterate that, as of February 21, 2024, there are no approved XRP ETFs in the US. However, understanding how potential XRP ETFs might target professional investors and the characteristics of this audience can be informative. Here's what we can discuss. Targeting professional investors. While specific details would depend on the individual ETF, some potential ways to target professional investors include 1. Minimum investment. Setting a high minimum investment amount to deter smaller retail investors. 2. Limited marketing. Focusing marketing efforts on industry publications and conferences frequented by professionals. 3. Complex investment strategies. Employing sophisticated investment strategies like active management or hedging, appealing to investors with advanced knowledge. 4. Direct sales. Targeting institutional investors directly through dedicated sales teams. Characteristics of professional investors. Professional investors typically share some common characteristics. 1. High net worth. They have substantial capital to invest and can withstand potential losses. 2. Sophisticated knowledge. They possess deep understanding of financial markets and cryptocurrencies. 3. Risk tolerance. They are comfortable with higher risk due to their potential for higher returns. 4. Investment objectives. They may seek specific goals like portfolio diversification, alpha generation, or exposure to the XRP ecosystem. 5. Access to information. They have access to specialized research and data not readily available to retail investors. It's crucial to remember. 1. Not all XRP ETFs may target professional investors. Some might be designed for a broader audience with lower investment minimums and simpler strategies. 2. Regulations may restrict retail access to certain XRP ETFs. This could further influence the target audience. 3. Investing in any asset, including potential XRP ETFs, carries inherent risks. Professional investors should still conduct thorough due diligence before investing. Alright, XRP enthusiasts, we've reached the end of this wild ride into the world of potential XRP ETFs. So, the big question, should you invest? Honestly, that depends. It's not a one-size-fits-all answer. Weigh the pros and cons, consider your risk tolerance, and do your own research before making any decisions. Remember, crypto is inherently volatile, and any investment carries risks. But hey, if you're intrigued by the potential of XRP and the convenience of an ETF, then keep your eyes peeled for regulatory updates and further developments in this space. It could be a game changer. In the meantime, drop a comment below and tell us, what are your thoughts on XRP ETFs? Are you excited, skeptical, or somewhere in between? Let's chat. Don't forget to like this video, subscribe to the channel, and hit that notification bell so you never miss an episode. We've got tons of exciting ETF content coming your way. Until next time, stay informed, stay invested, and stay awesome.